today joining us, we have Todd from First Republic Bank, Mara from Hawke Ventures, and Kayvon from Plug and Play. Thank you so much to the three of you for being here today, taking the time to talk to our founders about all things business funding. And to kick it off, I would like to have each of you just tell us a little bit more about yourselves, your background, your experience, and the companies that you work at. Would love to hear more about that. And then as this panel is about all things startup funding, also let us know what types of startup funding you personally have experience with, so that founders can kind of get a better sense of, who they should be reaching out to and connecting with further. Awesome. So yeah, just feel free to jump in here and take the floor. Anyone can jump in whenever they're ready.
Mara, you want to go first?
Sure. Thanks, Todd. Well, happy to be here. And thank you to Maya and Grid 110, and nice to meet you all. I'm super excited to be a part of this panel. My name is Mara, and I'm typically based in LA. Grew up in Metro Detroit, so if there are any Midwesterners out there. And it's a really exciting time for Detroit, actually, with a lot of the startup ecosystem growing over there too. So really excited about that. But a little bit more about me and my background. I am a cancer survivor. While fighting cancer in college, I got really interested in all things health, wellness, biohacking, mindfulness. And after becoming cancer-free, I'm almost 7 years cancer-free now. And moving out to Los Angeles, I got the chance to work at Summit in community building, so connecting thought leaders across every industry, including a lot of entrepreneurs and investors, which is where I feel I caught my entrepreneurial bug. I ended up leaving Summit to launch my first company called ZenStop, where I got the chance to share mindfulness and wellness practices through a tech platform and in person at times with companies like Universal Music, Snapchat, Disney, lots of tech and entertainment companies across the globe and LA. And more recently, I joined the investment team here at Hawke Ventures. We are strategic investors alongside Hawke Media, which is a marketing agency formerly based in LA, but now everyone's remote across the country as well. And so we predominantly invest in companies in pre-seed and seed stage, in e-commerce enablement, martech, ad tech. So I would say our focus is pretty niche in those types of tech companies, but have really grown relationships with a lot of different investors. So more than happy to connect you with investors who might be in other areas. So yeah, it's just a little bit more about me and what I do. In terms of your final question, Maya, was what funding pathways have I used before? I've actually, for my own company, financed through non-dilutive fundraising places like bank loans. Also did an equity, just like normal VC route. There's so many different ways. So I'm really excited for this conversation because I think there are a lot of ways to get creative. So anyways, just a little bit more about me. Popcorn, back to Todd.
Awesome. Thank you. And thank you again, Maya, not only for having us on, but for the work you guys are doing. Amazing organization. So Todd Brantley, Senior Managing Director with First Republic Bank. I'm based here in the Bay Area, originally from outside of Philadelphia. And I concur, I was actually at a conference last week where, the Detroit ecosystem is really, really thriving. So definitely, Mara, I see what you're saying there. I've been in finance for 20 plus years. So undergrad, I majored in finance and marketing, went on to do my MBA at Berkeley after moving to the Bay Area. My passion for finance and banking really stems from my beginnings and starting, in government housing and having no finance and no access to this world. So I really got captivated by trying to understand it and understand generational kind of wealth disparities. And so I get really excited about helping entrepreneurs, helping emerging fund managers, get connected to the right capital, and quite frankly, more importantly, avoid the wrong capital. And there's a lot of that out there as well. So I get excited for panels like this because I think they can be really huge just to help you navigate the do's and don'ts and avoid some of the really big missteps. And I think when it comes to financing, a lot of it is like most areas of your business, it's about finding partners and finding your team. So your legal team, your bookkeeping team, your finance providers are all part of trying to help you grow as a business. In terms of what areas of financing I've been directly responsible for in my role now, I lend to funds, I lend to nonprofits, conventional kind of bank financing. I've done SBA financing. I have clients that are crowdfunding. I work a lot with CDFIs, community development financial institutions that do lending before companies are really ready for a bank. And then I do a lot of work with nonprofits, so the whole grant side and kind of grant funding as well. So I've touched a lot of the different areas, not all, but I think this will be a good discussion today. And again, thanks for having us. Kick it over to you, Kayvon.
Awesome. Thanks, Todd. Yeah, I just want to echo everyone else. Thanks again for having me here. Really excited to speak with you guys and hopefully impart some wisdom. But some background on me. I actually had a bit of dilemma in high school. I was really debating whether I wanted to go more startups and tech scene or actually get into politics. And luckily I had the opportunity my senior year to do internships on both sides. So started with a startup, interned there for 4 or 5 months, really loved the culture that they had and loved like the idea of being a part of an innovative space. So kind of had that experience and then still wanted to test out the politics side too. So interned with a congressman. And, you know, that was an interesting experience, to say the least. And obviously you can tell what road I ended up taking eventually, but kind of decided I loved the idea of driving innovation through startups and entrepreneurs. And the legislation route was just, you know, a little bit too slow for me. I really liked the idea of moving quick. And so one thing led to another, ended up going to UCLA, studied econ and cognitive science, and really tried to entrench myself in the startup ecosystem there. So did a few internships, joined as many clubs that I could around entrepreneurship and venture capital. And that's really where I got a lot of my experience kind of working with VC firms directly. And from there, had the unique opportunity to run startup labs for 2 years at UCLA, which is their student-run accelerator program. Basically had the opportunity to mentor about 30 startups. And this is people that are my age, founding companies, as well as master's and PhD students as well. So it was a really cool learning opportunity for me and for them to be able to go through that. And now I'm here at Plug and Play on the ventures side, you know, sourcing startups, trying to find great opportunities to help founders. And some more background about Plug and Play. Basically, the way I like to describe it is we have 2 sides to it. So the one side is venture capital investing, as you probably imagine. We do about 250 investments a year. We have about 40 offices around the world sourcing startups. And so it's a really big operation. And LA specifically, we recently opened our office about a year ago. So I've had the opportunity to be here with about 2 or 3 other team members, just trying to launch the office here. And that's kind of involved doing a bit of everything. So making investments, sourcing corporate partners, which is also the second half of what Plug and Play does. We work with about 500 corporate partners around the world. Here in LA specifically, we're partnered with Meta and Red Bull, and we charge them an annual fee, and we're able to provide a lot of services for them, and all for free for the startup. So we run accelerator programs, and we don't take any equity. We run pitch sessions where we're able to introduce startups to investors and corporates that might be able to help launch pilots, and tons of other things that we try to do to help startups outside of just traditional capital investment. But yeah, that's a little bit about Plug and Play. In terms of like the investments that we do, it's pretty much all equity investing. We've done, you know, safe notes and that kind of thing, but that's typically how we help. And then we try to do, you know, programs like those accelerators to help make introductions to and help them kind of get to that next level.
Amazing. Well, thank you to the three of you for giving us a little more insight into yourselves. I don't know about everyone else joining us here today, but those intros just made me that much more excited to get into this conversation, just seeing the wealth of knowledge that we have here on this panel from Mara, hearing that you've been a founder yourself with your own company, and Todd, love how you listed off, all those different forms of capital that you've also touched on. And same with you, Kayvon, super interesting to hear your journey into the entrepreneurship world and how you coached and helped tons of founders and startups. So that was amazing. Thank you. Real quick, I did also want to note for our attendees joining us today, feel free to use the chat feature here on Zoom. If you've been to one of our Funding Pathways events before, you know that we try to keep this as interactive as possible. So if you do happen to have any other questions come up, I did get the questions you submitted when you registered. So we'll be focusing on those for the majority of the panel, but let's say you do have any follow-up questions, comments you want to add in the chat, feel free to utilize that feature. And same for our panel speakers, if there happens to be any resources or additional links that you have to add in there, feel free to use that as well. All right, so we're gonna just jump right into it here with the questions. First question, kind of focusing on, basic groundwork. This is what we're here for. I know Todd mentioned, kind of the do's and don'ts when you're approaching funding. That's what this is all about, and steering these founders in the right direction. So we had someone who submitted the question wondering what is the best way for founders to assess what form of capital is best for them and their business, when they're just starting out and realizing that they need to start fundraising, they have some traction, maybe they've been beta testing, and now they're thinking about fundraising. How can they start to assess, which of these many paths is going to be right for them, and what kind of questions should they be asking themselves? Any best practices you can provide on that? And again, speakers, feel free to just jump in here.
Yeah, I'm happy to jump in, and then Mara, Kayvon, love your perspective as well. But I think before you start taking any type of capital, it's understanding that there's pros and cons with every piece, right? And every type of capital. And I think there's a certain amount of self-awareness and reflection you have to do before you take capital on. So part of that is really looking at your numbers and your financials and having a good understanding of the financials and how they're driven. So what I mean by that is, understanding your cash flow, how you receive payment, how that comes about. It's one thing to book a new client. Some clients are going to pay you up front. Some clients are going to pay you in 90 days. And understanding the cash flow and how that relates to the other elements of your business is really, really critical. And then next to that, and just having firm and clear numbers, making sure the numbers are actually real. So that gets to bookkeeping and accounting. I think the second piece that's really important is a little more existential, is where are you really trying to take the business? So there are lifestyle businesses where, you'll be perfectly fine at a certain level of revenue. You're looking to maybe hire people in a certain community, maybe your friends and family network. You want to make sure you always have jobs for people, and it's more of a lifestyle business versus, we're trying to go public or we want to sell to a larger company in some years. Those are very different paths and can be very different in terms of driving the capital decisions. So I think those questions are really important before you take any capital, and they will help you see, is it more of growth capital in terms of debt, or am I really looking for a partner to really accelerate this and take this to the next level? Debt is really more about being able to service the debt. So whether that's credit card, SBA financing, bank debt, or even a CDFI loan, all those things are going to be driven by cash flow and your ability to service the debt. Whereas venture capital and angel investing is more about the growth trajectory, right? So I'll pause there, but I think just some basic things to think through beforehand.
That was very well said. Honestly, I would come to you if I had more questions about that. But yeah, I agree with everything that was just said. I would also say that I'm a big fan of trying, if you can, to do not a non-dilutive capital route, even though I do work in venture capital now, which is quite the contrary to what I'm suggesting. The more that you can do that and keep the equity in your company at the beginning, I think the better. But again, if you want to be able to grow faster, then venture capital is the route, I would say. Although I also think that even in my own VC firm, we really like to see traction about like 20K monthly revenue. And actually, I think that was one question that was like prepared for this, and I'm excited to talk through that too. So if there's any way that you could potentially explore a non-dilutive type route of like a bank loan or even like a credit card line at the beginning of your business, like get it going, you're also going to get a better venture deal if you have the metrics to prove it, and you can show that your ball is rolling. Then you're going to be able to negotiate better terms and keep more equity in your company when you're talking with venture capitalists. So that's just one other addition that I would add to that, but everything was perfectly said there.
Yeah, I also can't agree more. I think early on, it's smart to think strategically about how you want to spend your time. And I think a lot of the time it's just focusing on the product is going to be the best use of your time. Fundraising should be something, early on that you use other tools outside of venture capital and, private equity or anything like that to get your source of funding. And then I think once you get to the stage where you need that extra capital injection to get out of a plateau or whatever it is, I think the best thing to do would maybe find a mentor or advisor or someone that has some experience to really give you tailored feedback, because venture capital is great for a lot of startups, but some, I've had situations where startups will reach out to me looking for capital, and I look at their business and they're doing great numbers and they're asking for 2 million or whatever it is, and I'm like, I know you've probably heard what some people have told you in like general advice, but it's very, very important, I think, to get tailored advice for your situation, what your numbers look like, and making sure you make a right decision. Because with venture capital or anything like that, it's a long-term decision, and I would not want anyone to jump into that without kind of understanding all of the pros and cons that might come with that.
Kayvon kind of prompted Maya. Can I tag on to that?
Yeah.
Kind of prompted a thought, which is too, I think, capital can be dangerous from the standpoint of it can hide business model flaws, right? So I think part of that assessing where the company really is and understanding your metrics, as we talked about, is realizing that the view that if I just had 100,000, this could actually be a really viable business, or if I just had another 500,000, this could be a really viable business. It's really important to understand if you have a viable business, right? If the business model is working, absent of capital, and capital should be an accelerant of the business model, not something where you feel like that will actually make everything work out. So if your suppliers are not performing, if your customers are not coming back, if you have horrible reviews out there, social media, like getting an infusion of capital isn't going to change that necessarily. So you have to really understand, and it's great to do it in the absence of another boss, right? Whether that's a bank or a lender or venture, understand what some of these triggers are before you take on capital. So yeah, just don't use the money to kind of hide, what might be flawed with the business.
Yes, thank you. 100% echo all this and appreciate how I feel like, Todd, you gave us a very good foundation at the beginning there, kind of, what these founders should be asking themselves in terms of, what type of business they're in and how that's going to really set set them up to determine the funding. And Mara, I really appreciate how you mentioned non-dilutive capital, despite coming from a VC firm, because we are also all about, bootstrapping, non-dilutive capital at the beginning, and all the different ways you can get creative with finding different forms of non-dilutive capital. And also, Kayvon, really like that you mentioned, seeking like a mentor or a coach throughout the fundraising process, or even before thinking about fundraising. I think that's a very important piece of advice as well. And yeah, Mara, you mentioned something really interesting about traction, which I think we should dive into that question now. But another question that we got from our founders was, how do you define traction? The challenge I have is that all investors seem to define traction a little differently here and there. And I also think traction is something that is very as well industry dependent and dependent on the stage you're in, whether that's pre-product or post-product pre-revenue, things like that. But I think it's an important question, because whether you are trying to pitch your traction for funding, or perhaps you're just trying to apply to an accelerator or something like that, and need to present your traction in a way that makes your business look viable and attractive, it's definitely important to get into. So again, feel free to jump in on this one.
Yeah, I'll jump in real quick. I think, like, generally speaking, traction, a lot of people probably look at it as like whatever your new sales are, how many repeat customers you have, churn, that kind of thing. But I think it really depends on not only what you're selling, but the stage that you're at too. And it's fair that different people are telling you different definitions, because everyone probably has a different idea of what they're looking for. So it's important for you to probably know what your product is, and wherever you're at in that journey, like what is probably going to tell the best story of like how you know that this product has a great fit right now. So if you're very early stage, you're probably not going to have a lot of numbers to work with, and that's going to probably require more storytelling, more description on what the industry is looking like, and trying to tie that in with how your solution has already shown signs that it can help solve that. If you're later stage, I think numbers are always helpful, but you should be able to back that up by either having case studies or situations that really paint a better picture of where you guys have been able to get, and how you've been able to get to whatever point you're at right now.
I think, yeah, I love that. And I think everyone can define traction differently, as Maya mentioned. So traction, it could mean like monthly revenue, whether that be $1,000 a monthly revenue or $20,000 monthly revenue. But it could also look like, oh, I have 500 people that are signed up for my wait list, and as soon as I launch my product, these 500 people are going to convert into paying customers. So I think that traction comes from really understanding your ideal customer profile, which I think is the first step in finding product market fit. If you can really address the needs of the customer with what you are servicing or offering in your product, that's the way that you're gonna find like some kind of wedge in the industry that you're building in, and get your foot in the door a little bit. I think that there are plenty of investors out there that will be the first check-in for venture capital money, even like pre-product, pre-launch. I would be lying if I said that we actually haven't done that either. And typically when we are doing that, it's from like highly vetted entrepreneurs, of people who are in our network. Otherwise, we typically actually won't come in, because it's really risky for venture capitalists to have that first check-in when there is no traction. We've actually had a founder who he launched like in October of last year, and he's already up to 56,000 I guess it's already a year later. Geez, time flies. In monthly revenue, but he sat with 500 different Shopify merchants, which was like his ideal customer profile. And he observed their behavior on this platform that they've all been using. And then he built a platform that addressed their needs and problems. and he already has like 8,000 people on his wait list waiting for that next feature to be released for his product. So I think that traction can come in many forms. I think it's really, really important, and actually something that I could have done better in my first business, and I've learned a ton from that. So I think that whatever you do is going to be a great learning experience. But I think it is important to at least get in the market and get some testimonials and get some feedback and review for what you're doing, some like market sense of what you're building, to know that this is like something that's worth repeating and scaling.
Yeah, I would echo both of those comments. And I think Mara and Kayvon both said, like, you know, a lot of people will look at traction differently. And I think that gets to the point of, you know, every dollar in your company is not equal in terms of, there's capital that's going to be the dollar plus, and then there's capital that's going to be a dollar minus, meaning the dollar plus is additive in terms of advising and the things you should be looking for, and looking at your business model, making connections, potentially connecting you to other clients, and that's a partnership. The dollar minus could be where you're, as an entrepreneur, really thinking one thing and trying to go one way and constantly feeling like you're pulled in another direction. So I think just to be aware of, as you're gaining traction and as you're looking at some of these metrics, when you're interviewing firms, whether it's for equity investment or growth capital and debt, you know, you want to be looking at that. Is it a partnership? Is it aligned in terms of where you're trying to go? And that will help see, are the metrics that you're looking at important, or is it really kind of, if you're trying to get to another stage, they may not be the right metrics. So it all comes down to that relationship with the money, and it should be, your provider shouldn't just be about getting that check. It should be really about that connection and the partnership.
Totally. Yeah, founder investor fit is super important, Todd. So I'm glad you brought that up, and appreciate kind of all the anecdotes that Kayvon and Mara that you were able to provide. I think that really helps, you know, connect the dots for these founders, because as we've been saying, traction is very different for everyone, but super important to be able to wrap your head around. So I know we're just about the 30 mark, but we'll get in one more question for the panel and then kind of kick it to breakout rooms so that founders, you can ask some of those more specified questions. I did see we had a question here in the chat, someone asking about if anyone could speak to leveraging SBIR, so STTR programs. I don't know if any of our founders are able to speak to that, but maybe just respond in the chat and let them know, so that when we move to breakout rooms, they can, you know, pick your room and maybe connect with you further on that particular question. And things like that will be perfect to, you know, delve more into during those breakout rooms and more intimate conversations. But the last question here for our general panel, as we're all here together, is super important as well. This is kind of revolving warm introductions. And, you know, I know in venture capital and funding in general, that warm introductions can, you know, be kind of this double-edged sword, to where they're, you know, they can be very helpful to kind of have a referral like that. But then also, you know, it might kind of be hard if you don't have someone to give you a warm introduction and that's not available. So any advice to those who kind of don't have warm introductions, are still trying to, you know, expand their network and figure out how to do that, but how they can still make their cold outreach stand out and still grab the attention of these funds?
I would say two things. One is that investors are very different. So I would be sure to do some research on the investors that you're outreaching to, and make sure that you're reaching out to the ones that are in your domain. Some of them will say they're more general, in which case you can reach out no matter what domain you're building in. But be very intentional with the outreach and try to find investors in your domain, because those are the ones that are going to add the most value to your company as you grow. I'm actually going to pop this link in the chat, but this is a really huge list of VCs and funds that you can like sift through and then go onto LinkedIn and find like the actual people that work there. So I would say first off, just be very intentional about which investor and make sure they invest in the stage that you're raising at. And then my second thing is I highly encourage you to message the younger people, like message the analysts and associates, not the partners, because those are the guys that are going to be really incentivized at their firm because they want to bring really good deals to the table. And they're the ones that are like more willing to be collaborative and help you. So definitely pay attention to those because they actually have probably like the biggest say in what gets like paid attention to or not. So don't get swayed by the fact that someone's a partner or they're not. I would say the younger people are the ones that are going to be the most helpful. So yeah, don't be afraid to mess.
Yeah, just to add to that, I can relate because I'm kind of in that position right now, and I've seen it firsthand where when you're reaching out to a VC, those higher level people, they might not have the time, or maybe once you meet them too, they might not have the passion to really drive for that investment. Whereas like I'm in the position where if someone reaches out, conversation, and I think the product's amazing, I'm in a position where I can't necessarily give you that final yes or no, but if you sell me, then I can help try to sell you to the people that I work with. And so although I'm not making any final decisions, I'm kind of the one that's going to be either pushing for a yes or no and at the end of the day. So I think that's very helpful to know. Also, I think in general, when you're meeting VCs for the first time, first impressions are super important. Over email especially, I've had situations where startups can maybe think that their product is amazing and they want to pick and choose who's investing, and at the end of the day, that can kind of come across maybe rude or passive aggressive or anything. So I've seen at Plug and Play specifically situations where startups will do that, and it might have been an amazing company, but we ended up passing because we just weren't crazy about the way the founder interacted with us. And that kind of goes into other things like just being humble and honest, giving us all the information up front is always going to be better than waiting to share maybe bad news about certain aspects of the company. Eventually all of that comes out, and I'm telling you right now, that kind of bad news is actually great to hear, because we hear startups make amazing claims all the time, and it's hard to kind of dig through what the BS is. So being able to just know right up front, this is what I'm doing well at, this is where I'm struggling, this is why I need your guys' help, is always going to be the about it. And one more thing I just want to add to, some people might pay for services to get introductions or softwares that might be able to connect them with VCs. In general, I don't think that's the right way to go. I think just building out connections organically is always going to be stronger and probably going to, over time, net better outcomes than trying to pay for connections or anything like that.
Yeah, I think very well said. I think tomorrow's point about different VCs and different areas of focus, and then it kind of ties to Kayvon's point about mentorship. I think if you can be efficient from the standpoint of being in community, connecting with other founders who have raised before, to kind of get some of their experience where you can have that connection, and also different hubs and people who have connections to VCs, right? So that can be other providers, attorneys, banks, bookkeepers, et cetera. So some of that filter can be done for you and with you, to say, like, based on what you're looking to do, based on their thesis and their way and the way they operate, this would be a good connect. You will have to do some of that cold outreach, and I think the how is super important. But if you can have some people in your camp that have those connections, I think that could be helpful also. And then that can be part of the process too of, is this really even the right source of funding for you?
Totally, yes. So very well said. Thank you for all these amazing tips and tricks, kind of really touching on all areas of the process. Just want to thank our speakers again for a great panel conversation. Time is flying by, we're already about to be at the 40 mark. So I do want to make sure we have time for our breakout rooms, but yes, super appreciate all of the wealth of knowledge that you've been sharing here today.